Every day, millions bet everything on the market. Most lose. But a few, they're not playing that game. There's one question every trader, rookie or veteran, faces at least once in their life. It's not about technique, not about indicators, candlesticks, support, or resistance. It's this: what am I doing here? And why do I keep losing? If you're staring at your screen right now, if your account is bleeding red, if you just closed a massive losing trade, down 30%, feeling stressed and defeated, I want you to stop. Don't open another position. Don't try to win it back. Just sit still and listen to this story, because this story isn't about winning fast. It's about what 95% of traders never understand. That trading isn't a game of intelligence. It's a game of probability. And probability only speaks to those patient enough to listen. The man who knew how to read the tape. In 1891, inside a small bucket shop in Boston, what we'd call a financial gambling den today, a 14-year-old kid named Jesse Livermore was pulling in $5 a week. His job was to chalk stock prices up on a board, that was it. But Jesse wasn't just writing numbers, he was watching. He started noticing that prices didn't move randomly. There was a rhythm, there was a pattern. They breathed. Nobody taught him this. There were no trading schools back then. Jesse just stood there, day after day, and watched, patiently. Unnervingly patiently for a 14-year-old kid. The first time he placed a bet, he made $3.12, pocket change. But that feeling, the feeling of a probability, he'd calculated playing out as real cash money, it changed Jesse Livermore forever. I don't bet because I think I'm right. I bet because the numbers show me the odds are in my favor. Those are two completely different things. In 1907, the first major financial crisis of the 20th century, Jesse Livermore made $3 million in a single day. While everyone else was losing, panicking, praying the market would turn around, Jesse had already been short. Not because he knew a crash was coming, but because he'd read the probabilities. But here's the part most people skip over when they tell the Livermore story. He lost too, repeatedly. Lost everything. Lost so bad he had to borrow money for food. In 1908, fresh off his historic win, Jesse made a bad bet on cotton and dropped nearly everything he had. He had to start over from zero. Then came 1929, Black Thursday, the day that gets its own chapter in every economics textbook, and Jesse Livermore went still again. He'd been shorting the market for weeks. When the Dow collapsed 25% in 2 days, when millions of Americans lost everything, Jesse walked away with $100 million. That's the equivalent of roughly $1.5 billion today. Wall Street never changes. The pockets change, the stocks change, but Wall Street never changes, because human nature never changes. But Jesse Livermore's real tragedy wasn't the losses, it was the wins. Because when you've made $100 million, when newspapers are calling you the great bear of Wall Street, when your name gets whispered in trading rooms with something close to fear, you start believing you're special, that the rules no longer apply to you. And that's when Jesse Livermore started dying. He broke his own rules. He traded on gut feeling. He stopped waiting. He stopped sitting still. He acted out of FOMO, out of ego, out of 100 reasons that had nothing to do with probability. By 1934, Jesse Livermore was completely broke, buried in debt. His family had fallen apart. On November 28, 1940, in the coat check room of the Sherry Netherland Hotel in New York City, the man who once made $100 million in a single day ended his own life. He left a note behind, and in that note, he called his life a failure. Not because he wasn't gifted, but because he didn't have the patience to hold on to his own principles. The man who broke the Bank of England. The story of George Soros, and what it really means to know when to act. To understand the George Soros story, you need a little context. In 1992, the United Kingdom was a member of the ERM, the European Exchange Rate Mechanism. This meant the British pound had to stay within a fixed range against other European currencies. The problem was, the British economy was a mess. High interest rates, high unemployment. People were struggling. But to stay in the ERM, the Bank of England had to artificially prop up the pound by buying pounds and hiking rates even higher. It was like a man who's bleeding out but has to keep smiling so nobody notices. Soros saw this. He wasn't the only one who saw it. Plenty of people did. But Soros was the only one with the conviction and the patience to bet against it at a scale large enough to actually matter. He'd been studying the situation for months. Not days, not weeks, months. He talked to economists, to politicians, to people inside the system. He built an investment thesis, and then he waited. When he was ready, he put $10 billion on the British pound collapsing, shorting sterling at a scale the world had never seen. That day became known as Black Wednesday. The British government lost an estimated $3.3 billion trying to defend its currency. They hiked interest rates to 15% in a single day in a desperate attempt to stop the collapse. Didn't matter, the market had already decided, and Soros was standing on the market side. I don't fight the market. I figure out what the market wants to do, and I get on its side. But here's the part most people don't know. Soros was fully prepared to lose. Just before committing $10 billion, his partner, Stanley Druckenmiller, had proposed a $1.5 billion bet. Soros asked him, "Why only $1.5 billion? If our thesis is right, why aren't we going all in?" And then he pushed the position to $10 billion. This wasn't recklessness. This was a deep, crystalline understanding of probability and scale. Soros had analyzed the situation until he was over 90% confident in his thesis. And when you're over 90% confident, keeping the bet small is actually a form of self-doubt, not caution. But here's the most important thing. Soros always knew exactly where his stop-loss was. If the pound didn't break and if he was wrong, he'd already decided how much he was willing to lose and at exactly what point he'd walk away. Probability isn't certainty. Even a 90% edge carries a 10% chance of being wrong. Soros never forgot that. The human brain, a trader's worst enemy. Let me tell you about an experiment. Scientists tracked the brain activity of professional traders and amateur traders while they were actively trading. The results were so striking that they're almost hard to believe. When amateur traders saw a position moving into profit, their brains lit up exactly the same way an addict's brain lights up when they see their drug. Dopamine flooding the system. They wanted more, but they also desperately wanted to lock in that feeling before it disappeared. A perfect paralyzing paradox. When a position was going against them and showing a loss, their brains responded the same way as someone being chased by a predator. The amygdala took over. Clear thinking was gone. They needed to act immediately to stop the pain, either close the trade and take the hit, or convince themselves the position would come back. The second option always feels easier, and it's almost always the wrong one. Professional traders. Their brains barely flickered. In either scenario, they'd conditioned their minds to the point where winning money or losing money was just information, not an emotional event. This is why patience in trading isn't a moral quality. It's a neuroscience skill. You're literally training your brain not to react to stimuli that would normally hijack it completely. The hardest thing in trading isn't the technical side. It's sitting there doing absolutely nothing when every single instinct in your body is screaming at you to do something. Daniel Kahneman, the Nobel Prize-winning psychologist, showed that human beings feel the pain of losing money roughly twice as intensely as they feel the pleasure of gaining the same amount. Losing $100 hurts about twice as much as winning $100 feels good. This creates a dangerous psychological bias called loss aversion. And in trading, loss aversion makes you do exactly the opposite of what you need to do. You cut your winners too early because you're afraid of giving back gains. And you hold your losers way too long because you can't bring yourself to make the loss real. You keep hoping it comes back. That mindset is a slow, quiet death sentence for your account. Livermore captured this perfectly. Nothing is more costly in trading than hope. Hope is one of the most beautiful things in ordinary life. But in trading, hope is the thing that quietly destroys your account. Don't play to win, play not to lose. Lessons from Paul Tudor Jones and the philosophy of capital preservation. Paul Tudor Jones is one of the most successful traders of the 20th century. He's the man who predicted the crash of October 1987, Black Monday, the single worst day in stock market history, when the market dropped 22% in one session, and didn't just survive. He tripled his fund's money that month. But the secret to Jones's success wasn't some preternatural gift for prediction. He was wrong all the time, plenty of times. What made Jones different was his philosophy on risk. Jones said, "I care more about making money than I care about proving I'm right." Sounds simple, but most traders have this completely backwards. They care more about being right than about making money, and that's the whole problem. His first and absolute rule: never risk more than 1% to 2% of your total capital on a single trade. Not because he was timid, because the math demands it. If you lose 50% of your account, you need a 100% gain just to break even. But if you only lose 10%, you only need an 11% gain to get back to flat. Capital preservation isn't defense. It's your most powerful offensive weapon. Jones has a piece of advice I want you to actually remember. If you have a losing position that's making you feel sick to your stomach, just cut it in half. Once you cut it, you'll feel twice as good. This isn't emotional advice. This is risk management. When you're carrying a position that's too large for your psychology to handle, your brain cannot function normally. You're making decisions from a place of fear and desperation, not analysis. Reducing position size literally frees your mind to think clearly again. The most important thing in trading is capital preservation. Opportunities are always coming, but if you run out of capital, you run out of opportunities. Sitting still is a skill, not laziness. Let me describe a paradox I've seen in almost every failing trader. They're more afraid of missing out than they are of losing money. FOMO, fear of missing out, is the real silent killer of trading accounts. The market is ripping. You don't have a position. And a voice in your head starts getting louder. "Why aren't you in? You're going to miss this. It's not too late to jump in. Everyone's making money right now except you." And so you enter, not because your setup appeared, but because you simply couldn't sit still. Jesse Livermore had an ironclad rule. He never entered a trade just because he felt the market was going somewhere. He waited until the market itself confirmed its direction before he stepped in. This meant he routinely missed the first 10 to 15% of a move. But he'd say, "I never buy at the bottom and I never sell at the top. I buy what's going up and sell what's going down, once I'm certain." Sounds straightforward, but it's incredibly hard to actually do, because waiting for certainty means accepting that you'll miss things, and missing out hurts. Sitting there watching a market explode higher without you on board is a special kind of agony. But weigh the two. The pain of missing the first 20% of a move versus the pain of losing real money by entering at the wrong time. The first pain is emotional. The second pain is financial. Great traders choose emotional pain over financial pain. Every single time. Warren Buffett, not a trader but a master of the same fundamental truth, once said, "The stock market is a device for transferring money from the impatient to the patient." This isn't a metaphor. It's a technical description of a financial mechanism. When you panic sell, who's buying from you? The patient investor who's been waiting for exactly this price. When you FOMO buy at the top, who's selling to you? The patient trader who's been holding since the bottom and is now cashing out. The market is a continuous, relentless transfer of wealth from the undisciplined to the disciplined. Bet big when you see clearly. The art of Druckenmiller. Stanley Druckenmiller managed money for Soros for years, and then went on to build his own track record that no other hedge fund has ever matched. 30 consecutive years without a single losing year, averaging north of 30% annually. Druckenmiller's philosophy runs completely counter to conventional financial wisdom. Don't diversify. Instead, when you find an opportunity you truly believe in, bet big. He said, "Diversification is for people who don't know what they're doing." That sounds arrogant out of context, but here's what he meant. If you're putting 1% into every idea because you're not truly confident in any single one, you'll never make enough on the winners to overcome the losers. But when you focus deeply on a small number of ideas you understand completely, you can bet larger with genuine conviction. I've learned that an investor has to master their emotions completely and not let them interfere with their judgment. But when you believe in an idea, believe in it all the way. Stanley Druckenmiller. But here's the critical thing most people miss when they hear Druckenmiller's concentrated bet philosophy. Before he ever bet big, he researched obsessively. Not for a day, not for a week, sometimes for months. He stress-tested his thesis from every possible angle, actively looking for reasons he might be wrong before making any commitment. This is the paradox of patience in trading. You're patient in waiting for the perfect setup, patient in building your research and conviction, but the moment the opportunity arrives, you act decisively and without hesitation. Your system is the only thing you can actually control. Here's a truth that's uncomfortable for a lot of people to sit with. There is no trading system that's right all the time. There is no magic indicator that tells you exactly when to enter and when to exit. There is no holy grail. But here's what does exist. A system with a positive probability edge executed consistently across hundreds and thousands of trades will produce positive returns over the long run. Not because every single trade wins, but because a positive expected value, compounded over time, always works in your favor. Casinos know this. The house edge in roulette is only 2.7%, meaning for every $100 wagered, the house expects to keep $2.70. Not much, but multiply that by millions of bets, and 2.7% becomes billions of dollars a year. The professional trader is the casino. They don't win every hand. They have a system with a positive probability edge, and they execute that system with such consistency, such emotional detachment, that the individual trade becomes irrelevant. The sequence of thousands of trades is all that matters. So you don't need to predict to make money. You need a system and the discipline to follow it. Ed Seykota, who turned $5,000 into over $15 million in 16 years, Ed Seykota, one of the greatest trend followers who ever lived, built his trading system in the early 1970s on a primitive computer. The system was almost laughably simple. Buy when the price breaks above a long-term moving average, sell when it drops back below. That was it. Nothing more complicated. But he followed that system absolutely. Even through runs of 10, 15 consecutive losing trades, even when friends laughed at him, even when every instinct screamed that the system was broken, he executed every single signal like a machine. The result? $5,000 in 1972 became over $15 million by 1988, a return of 250,000%. Time, your one true ally. Let me talk about a concept that every serious trader needs to internalize completely. Compound interest. Einstein, whether he actually said it or not, was right to call it the eighth wonder of the world. In trading, compounding is your single most powerful ally, but only if you give it the one thing it absolutely requires: time. Say you have $10,000 and you make 2% a month. Not 20%, not 50%, just 2%. After 1 year you have 12,082, a 26.8% return. Good, not spectacular. After 5 years, $89,216, nearly 9 times your starting capital. After 10 years, $796,116, almost 80 times your money. 10 grand becomes nearly $800,000, with just 2% a month. But here's the brutal truth about human nature and time. We want results now, not in 10 years, right now. And that desperate need for immediate results drives traders to over-risk, over-trade, make poor decisions, and destroy the beautiful compounding curve before it ever gets a chance to do its work. Soros said in one interview, "I'm not rich because I'm smarter than the market. I'm rich because I've stayed in the game long enough." Notice the word long enough. Not smart enough, not skilled enough, long enough. To stay in the game long enough, you need to do 3 things. Preserve your capital, keep your psychology intact, and never risk so much in a single trade or losing streak that you get wiped off the board entirely. That's really all there is. Nothing magical beyond that. Back to Livermore and the real lesson. We've talked about Livermore winning, about Soros winning, about the glorious cinematic moments, But now I want to talk about something more important than any of that, about why even the genuinely gifted can fail. Jesse Livermore went broke 4 times in his life. 4 times. And each time he found a way back. Each time he learned something. But the final lesson, the most important one, came too late. The lesson was this: success is the most dangerous enemy a trader has, not failure. Failure teaches you. Success, especially big, fast success, convinces you that you're exceptional, that the rules no longer apply to you, that you've finally figured out the market. And that's when the market delivers its most expensive lesson. Nobody is exceptional. Probability doesn't care about your reputation or your track record. Every single trade is a brand new, independent event with its own set of odds. Soros understood this. That's exactly why, even after breaking the Bank of England, even after becoming a living legend, he still maintained his stop losses, still managed his risk like it was day one. He said, "I'm wrong more often than I'm right. But when I'm right in a big way. And when I'm wrong, I make sure I'm not losing much. I'm not ashamed to change my mind completely. I'm only ashamed if I'm wrong and refuse to change." This is the deepest difference between traders who lose and traders who win. Traders who lose protect their opinions. Traders who win protect their capital. If you ever have to choose between the two, and always protect the capital. How to actually sit still and let time do the work. Talking theory is easy, but trading happens in reality, in those moments when your screen is red and your heart is pounding. So how do you actually practice patience when it matters most? Step 1. Build your trading plan before the market opens, not while it's moving. Before that. When you're calm, when no money is at risk, when your brain can actually think straight, write down exactly, I will enter if, I will exit if, I will do nothing if. Specifics, not vague intentions. Then when the market opens, your only job is one thing: execute the plan. Don't improve on it, don't add layers to it. Don't tell yourself, but today feels different. Just execute the plan you wrote when you were calm, because yesterday's version of you was the wiser one. Today's version is in the middle of the chaos. Step 2. Keep a trading journal. Not a trade log, an emotional journal. After every trading day, write down, what was I feeling when I entered that trade? Was I afraid of missing out? Was I afraid of losing? Why did I close that position when I did? After a few months of doing this, you'll start seeing recurring patterns in your own behavior, and that's when real improvement begins. Step 3, and this is the most important one: clearly define what your edge actually is. Not, I think the price is going up, but across 200 trades using this exact setup, my win rate is X%, my average reward to risk is Y, and my positive expectancy is Z. If you don't have those numbers, you don't have an edge. You're just gambling. What nature can teach you about trading? There's a beautiful paradox buried inside trading that I want to share with you. When you look at a chart, you're looking at history. The price line you see represents transactions that have already happened. You can't change them. All you can do is make a probabilistic judgment about what might happen next, based on context, experience, and a clear-eyed reading of the odds. And here's the wonder of it. The market, like nature, is never in a hurry. A major trend doesn't form in a single day. A true bottom doesn't get confirmed in an hour. The biggest opportunities, the ones that Livermore, Soros, and Druckenmiller identified, they formed slowly, quietly over months and years. And the traders who had the patience to see them, the ones who weren't distracted by short-term noise, who weren't getting sucked into intraday swings, who could see further out than the next hour, those were the people who made the real money. Chinese Moso bamboo spends the first 5 years of its life developing its root system underground. For 5 years, you see nothing above the surface. Nothing. Then, in its 6th year, Moso bamboo grows 90 feet in 6 weeks. If you give up after 4 years, you never see it happen. The market doesn't reward knowledge, it rewards patience and discipline. Anonymous, but true enough to print on the wall of every trading room in the world. Trading in the modern world, and why humans still have an edge. You might be thinking, that was Livermore's era. That was Soros's era. Now we have AI, high-frequency trading, quant funds staffed with PhDs, what chance does an individual actually have? The answer is a real one, but not in the way you might expect. You cannot beat the machine in the short run. You cannot react faster than an algorithm. You cannot process more data than an AI. But you have something that no machine has, an unlimited capacity to wait, the ability to see the full picture, and the ability to make qualitative judgments about things that data hasn't captured yet. Soros didn't win because he processed information faster. He won because he understood human nature, politics, and history, things that no algorithm in 1992 could quantify. He called this reflexivity, the recognition that markets don't just reflect reality, they actively shape it. And today, as AI gets better and better at analyzing historical data, the human capacity for qualitative thinking, the ability to understand context, intent, and variables that haven't been measured yet, becomes more valuable, not less. But to leverage that edge, you need time. You need to sit still. You need to allow yourself to do nothing while the machines are frantically trading all around you, and wait until the big picture is clear enough, undeniable enough, to step into with conviction. The one thing every great trader agrees on. When you read enough about the great traders, when you sit with their books, their interviews, their personal letters, you notice something striking. They don't agree on very much. Livermore loved short selling. Buffett hates it. Soros believes in global macro. Lynch believed in small companies he could understand personally. Druckenmiller concentrates. Seykota follows trends. Each one has a different style, a different analytical framework, a different preferred market. But when you ask all of them what causes traders to fail, they are in complete agreement. It's not bad technique. It's not lack of information. It's lack of discipline, inability to manage emotion, and not having the patience to wait for the right moment. Peter Lynch, who ran the Magellan Fund at an average of 29.2% annually for 13 consecutive years, said, "The organ that does the worst job of predicting the market when it's moving is the stomach, not the brain. The stomach. That queasy, sinking, panicked feeling, that is the real enemy. And the only way to fight that enemy isn't to try to feel nothing. It's to build a process, a plan, and a system solid enough that you don't need to feel anything in the moment of a decision, because the decision was already made back when you were calm. The final part, sit still and let time do the work for you." I want to close this story by returning to Jesse Livermore one final time, not to the glory of his greatest wins, but to something he wrote in his final years, after he'd lost everything, trying to understand why. He wrote, "After many years in the market, I've come to understand that nobody can consistently make big money in the market unless they grasp that big money isn't made from understanding the market. It's made from understanding yourself. Understanding yourself. Knowing when you're afraid and acting out of fear. Knowing when you're greedy and reaching for more than the probabilities justify. Knowing when you're stubbornly defending your ego instead of defending your capital. Knowing when to act and when to go completely still. Trading is one of the few pursuits in life where hard work and constant activity can actually hurt you. Where doing less is often better than doing more. Where the answer to, what should I do right now, is more often than you'd expect simply nothing. Doing nothing isn't surrender. Doing nothing is strategy. It's the understanding that the market doesn't pay you for activity, it pays you for results. And sometimes the best result comes from sitting still and letting time do the work. George Soros didn't break the Bank of England by trading more. He did it by waiting until the probability was so overwhelmingly in his favor that there was no honest argument against it, and then acting with everything he had. Jesse Livermore didn't make his millions by staying in the market constantly. He made them by knowing when to stand aside, and when his setup appeared, stepping in with an unshakable confidence. And you, whoever you are, whatever your account size, wherever you are in this journey, you are capable of doing the same. Not by being smarter, not by adding more indicators or finding another strategy, but by truly understanding that trading is a game of probability and patience. And probability, when it's managed correctly, executed consistently, and given enough time, always speaks. It speaks very slowly, but it speaks with absolute clarity. You just have to be patient enough to listen. If this story hits something inside you, stop. Don't open your trading app right now. Don't place a trade to prove something. Just sit with this question for 10 minutes. What is my system? What is my edge? Am I trading based on probability or based on emotion? That's step one. Not learning another indicator, not finding another strategy. Just sitting still and asking yourself the hardest question there is, what am I actually doing here? Jesse Livermore, George Soros, Stanley Druckenmiller, Paul Tudor Jones, none of them started as geniuses. They started as losers, as learners, as people willing to face uncomfortable truths about themselves and about the market. And then they changed. Not their strategies, themselves. That's the real story of trading, not money, people.